So NVIDIA back, along with a lot of other good companies. CoreWeave beat top and bottom line earnings estimates, reporting 400% growth. That is not a typo. In its first quarterly report in the IPO. And I've got to tell you, it is great to have New Jersey's own, not Silicon Valley, CoreWeave CEO Michael Intrator here. And Michael, I've got to tell you, first of all, congratulations. At one point when you were fighting to get that deal done, you and I got together and I checked out the data center. I said, this thing is a gem. Well, it turned out, given both the demand and how much money you're making EBITDA, people got in on this deal. They made a lot of money.
Yeah, the stock's been performing well, but more importantly than that, the company had an amazing quarter. It's really set itself up to have an amazing year. You saw us lift guidance for the full year. You saw us beat in the quarter. It's really, it couldn't have been a more effective quarter for the company as we've kind of built and driven our technology into the market.
Now, some of that is because of your expertise, and we're going to go into that because it's sui generis. No one has that. You're much more sophisticated. But I'm using the word staggering when it comes to demand, accelerating and staggering.
Yeah, there's a whole lot of superlatives that you can throw at the demand that the entire space is seeing to deliver this type of highly performant infrastructure, and the quality of the environment that we build, the software stack, as you said, that enables such incredible performance on our infrastructure, just really allowed us to have an incredibly effective quarter building the business.
I know everybody wants to play because this is actually a very exciting thing, but I have to tell you, it seems like that when you said that this is purpose-built, that the other guys have legacy, that you have an expertise because these things are tricky places and you can actually borrow. You borrow and you make money after 4 years. All of these things are playing into your hand versus, I don't know, you've left the competitors in the dust here.
Yeah, well, look, it's very exciting. We are a disruptor in the space to deliver this type of infrastructure, and when you're in that position, when you have the privilege of sitting in that role, you get to really reconstitute how compute is going to be delivered to the clients, and we've done that. We've built our software stack from the ground up. And we have built an environment that provides for the most performant configuration of delivering this infrastructure. It has the ability to allow people who are spending enormous amounts of money on this infrastructure to allow them to build their company, to run it in an environment that allows them to extract the most possible value from the infrastructure they're building.
How are you thinking about Capex versus the margins that the street is expecting?
Yes, so it's a great question, and this one we're getting a lot. And ultimately, the demand signals that we're getting from our most important clients, from the most important consumers in the world of this infrastructure, are we need this infrastructure sooner, we need it larger, we need it now. And with that signal, we are accelerating our growth. We are investing more to pull in our data centers. We are investing more to be able to deliver the physical infrastructure to our clients sooner. And with that, you're seeing us increase our Capex budget. And I want to be very, very clear on something here. The increase in the Capex budget is driven by success within the company. We are out there, we are finding clients that come to us and say, we need to buy your infrastructure only when they tell us that only when they execute a contract with us that allows us to go to our lending syndicate and say, we need to borrow money to build the infrastructure to deliver to this client. They look at the contracts, they understand the contracts, they understand our business, and they continue to lend us money so that we can scale and deliver. And the other point that's really important here is you got to understand that we are able to build this infrastructure and repay the entire infrastructure fully loaded within the four corners of the contract, within the term of the contract. So think of it as, we get a contract for $200, we go back to our lenders, we borrow $100. By the time the contract is over, we have paid that $100 back, and there is a significant remainder that is the profit to the company. Never mind what the infrastructure is worth beyond the contract term.
Right. I mean, you said it on the call. You utilize naturally deleveraging, self-amortizing debt facilities. You're sure the money's going to be there. And, you know, Michael, when you went public, that was seemingly a concern or lack of understanding, perhaps, in terms of, all right, you just increased Capex to $22+ billion, let's say, roughly. You got, you know, $8.5 billion in debt now, $3 billion in cash. Where's the money come from? And you're going to have negative $19 billion in free cash flow. So just come back to that theme and explain to those who are at least uncertain as to exactly how the business model works.
So like, ultimately, you can't take one side of the ledger without contemplating the other side of the ledger, right? So yes, we are going to invest $19 billion. We are going to invest $21 to $23 billion. On the other hand, we have executed contracts for in excess of $29 billion that is offsetting that. And so you can see within the contract terms, you have the ability to build, to run, and to be in a position to repay all of the debt with a significant amount of excess revenue that shows up as profit, in addition to the fact that you own the infrastructure at the end of the term, which will have residual value.
Right. And you're confident that financing will always be there for you, that asset-backed financing, that market that you're relying on.
Yeah. So, look, I mean, it's once again, it's success-based. It's a success-based business. If the cost of us accessing capital goes up, then the contracts will become more expensive. That is embedded in the total comprehensive price that we charge our clients. The indication from all of our clients is that they have enormous demand for the infrastructure, and the indication from the lending syndicate is there is enormous capacity to lend to us based on the structure of the contract deal that we deliver.
Obviously, your backlog went up dramatically, even with this concern about Microsoft, which originally was as much as 60+% of your revenues, at least in the S1. What are your expectations for Microsoft as a client versus, again, OpenAI now coming in with a big order, and/or I thought Alphabet there had been some expectation perhaps they would, but I don't think I've seen it as yet.
Yeah, so a couple of things. Sure. We're not going to talk about specific clients. We don't.
Figured that.
But what I will say is that we have added another hyperscaler to our client list, which is wonderful, right? And we always think about this as this is the first stage of ramping up enormous contract relationship with them. They come in, they use our infrastructure. It's fantastic. Once they use it, they begin to use it again and again and again. It's what we've seen with all of our customers. We're incredibly excited about that. With regards to like how we go about diversifying our clients, there's two distinct things that need to be understood. One is there are very large consumers of this infrastructure.